In 2025, it's estimated that more than 70 million Americans work in the gig economy, at least part-time. In today's video, I'm going to break down the list of 5 powerful tax strategies that gig or freelance workers can use to reduce their tax burden. I've been asked all the time, what strategies apply to freelance workers, gig workers, and this is the video for you. Let's get started. Many different types of freelancers and gig workers work from their home. You see, a lot of these people have dedicated home offices setups, and they do the vast majority of their work from their home offices. For example, many freelancers are graphic designers, they're video editors, they're bookkeepers, copywriters, virtual assistants, YouTubers, and many of these people are working from home. The good news is that if you're a self-employed gig worker, you can take the home office deduction if it's your principal place of business, and you can write off your office expenses. Home office expense deductions can be worth thousands of dollars. You can claim the home office deduction by using either the simplified method or the actual expense method. In 2025, the simplified method allows you to deduct $5 per square foot, but only up to a maximum 300 square feet. So you'll max out at a maximum $1,500. But the actual expense method allows you to take the actual square footage of your home and take a portion of your actual business use of the home. This can lead to a much bigger expense. I always have my clients record both so that we can determine what ends up giving them the better write-off. Number 2 is switching from an LLC to an S corporation. You see, a lot of freelance and gig workers will start out as LLCs when they're getting started. If you're a sole proprietorship, you may move up to an LLC. If you have an LLC, you may eventually move up to an S Corp. And this is because LLCs limit your liability and they have pass-through taxation, and it makes it easy for compliance. However, the issue with LLC owners is they have massive 15.3% self-employment taxes, and this is not going to help you much when you're making over $50,000 to keep paying this year after year. So LLC owners start to save money in taxes the moment they switch from an LLC to an S Corp. Self-employment tax issues are one of the main issues that have caused clients to reach out to my firm over the past couple of years. Switching from an LLC to an S Corp can result in substantial amount of self-employment tax savings. And this is because when you switch to an S Corp, you can pay yourself in 2 different ways, through a salary and through distributions. But you only have to pay self-employment taxes on the salaried portion. So you can take a portion of your income as a salary and a portion as a business distribution. This means you'll only pay 15.3% self-employment tax on the salary. Doing this exempts a large portion of your income from self-employment taxes, which can result in a tremendous amount of tax savings. Using retirement accounts. If you're a freelancer or you're going to be a gig worker, then obviously you will not be able to get a tax advantage retirement account from an employer. You work for yourself. However, that doesn't mean that you can't still use retirement accounts to save money on taxes. That's silly. You see, as a freelancer, you will still have several great tax advantage retirement accounts that you can set up. For example, you can either get a traditional or Roth IRA. IRA stands for Individual Retirement Account, and these accounts are open to freelancers and gig workers. With a traditional IRA, you can make pre-tax contributions that will reduce your taxable overall burden. Then you pay taxes on withdrawal later on in retirement. With a Roth IRA, you make contributions with after-tax money. Then your account grows entirely tax-free, and you can make tax-free withdrawals during your retirement. Both of these are great options, but you can also choose to go with just a solo 401k. Solo and 401k is similar to a regular 401k that a company might offer to employees. However, there are some important differences. With a solo 401k, you're able to contribute both as an employee and as an employer. This increases the total contribution limits. For 2025, the total contribution limit is $70,000 if you are under age 50 and $77,500 if you're above the age of 50. For comparison, the most you can contribute to a regular 401k offered by an employer is $23,500 if you're under the age of 50, or $31,000 if you're between 50 to 59 years. See, you can contribute more to a solo 401k than you can to a regular 401k. Now, another great benefit of solo 401ks is that you can choose the investments yourself. This gives you much greater control over your retirement account. If you want to learn more about solo 401ks, check out this video right here that I made for you. Deducting health insurance premiums. Freelancers and gig workers do not get employer-provided healthcare, so they typically buy their own insurance through the insurance marketplace. Many freelancers find it annoying that they have to pay for their own health insurance. However, the good news is that the government allows them to deduct 100% of the premiums. Freelancers are allowed to deduct their health insurance premiums even if they do not itemize their deductions. As many of you are watching this video probably know, Health insurance can be quite expensive. In fact, in 2024, the average cost of health insurance premiums was around $8,900 a year. So being able to deduct the cost of health insurance premiums is extremely beneficial as a taxpayer. However, in order to be able to deduct health insurance premiums, your freelance or gig business has to be profitable, or else you're not deducting it against any income. Deducting costs for the business use of your vehicle. Now, a wide variety of freelance gig workers are using their vehicle for business purposes. I'm well aware of this. For example, construction contractors might have to drive to and from various job sites, suppliers, and vendors on a daily basis. And if you're self-employed and getting paid $10.99 and you use your vehicle for business purposes, you might be eligible to claim the vehicle tax deduction on your returns. The vehicle tax deduction allows you to deduct costs associated with the business use of your vehicle. You can calculate this deduction in two different ways. The first method is the standard mileage rate. This method allows you to deduct a certain amount of money from every business mile that you drive. In 2025, the standard mileage rate is 70 cents. So to understand how this works, let's say you drive 5,000 business miles in 2025. If we use the standard mileage rate to calculate your vehicle tax deduction, we would multiply 5,000 miles by 0.70. This would give me $3,500. So if your taxable income for the year was $60,000 for the year, then you would be able to deduct it down to $56,500 by using the vehicle tax deduction in this circumstance. Now, the other way to calculate the vehicle tax deduction is with what's called the actual expense method. With this method, you deduct the actual cost associated with operating your vehicle for business purposes. Guys, this includes expenses such as the gas, the oil changes, the repairs, the maintenance, the insurance, the lease payments, the registration, the depreciation, the parking fees. After you calculated the total cost, then calculate the percentage of business use of your vehicle, which is the total business miles driven divided by the total miles driven in the calendar year. Using this method can lead to a far more substantial deduction than the mileage deduction, depending on what type of business owner you are. All right. Now I'm going to answer a question from one of my subscribers. This question was asked by RussellNow3791 on my It All Starts with the LLC video. The question is, what is a disregarded entity? A disregarded entity is a single member LLC or a sole proprietorship. For tax purposes, you're not considered a formal entity in the eyes of the IRS. You file your business tax returns on a Schedule C inside of your individual tax returns. The reason why this is so important is because disregarded entities are more highly audited than partnerships or S corporations. Why is this? Because of their filing status. Because you file that return, that Schedule C inside of your individual tax returns, all of your information is all nice and neat inside of one place. Plus on a Schedule C, you have to define all of your expenses in the categories inside of the tax return. It could absolutely expose your tax return to more audit risk. A majority of my clients operate inside of partnerships or S corporations to avoid Schedule C businesses, sole proprietorships, but we do have a few clients that have to operate as single member LLCs due to their filing status. If you have any questions around your entity structuring, you would like us to take a look under the hood, look no further than Tax Alchemy. Click on the link below to schedule a complimentary consultation with my team, and we'd be more than happy to help. Thank you guys so much for making it to the end of this video. I hope if you're a freelancer or a gig worker, we get the opportunity to work with you. But if we don't, we know that this channel will help you on your path to saving money on taxes. Thank you so much for watching this video. Go ahead, like, comment, subscribe, share with one other freelancer that's out there that needs to save money on taxes this year. This video will help them. Thank you.